Welcome traders. This is Kevin from TraderTalkOnline.com. Just want to jump over here on a break from my live session. Question I was asked this morning was should I use a trailing stop or a fixed stop? I just kind of wanted to go over a little bit about each one of them here real quick before I have to get back. I usually don't use a trailing stop. I seem to have bad luck with those. I seem to always get stopped out, and then the stock always seems to move higher. So I'm usually always watching the positions I'm in. So I always use the fixed stop if I use a stop at all. I usually just do a mental stop, unless I have a lot of positions open. Then I might put in a stop. So I don't have to continuously babysit it. But if you're not going to watch your position, say you enter into a position and you only are going to into maybe a swing trade and you're only going to check it maybe one time a day, then I would recommend either putting in a trailing stop or a fixed stop, and then you just have to go in there by hand and move up your fixed stop, or in that situation you could use a trailing stop. If you don't know what a trailing stop is, let's get into, let's see, Caterpillar here. If you were to enter into a stop right here at say 59.40, you wanted to put in a trailing stop at 59, about 40 cents below. That stop would follow the price. That stop would follow the price up. Say the stock went up to 60, that trailing stop would follow it up to about 59.60, and then if that stock turned, it would sell it when it went down to your trailing stop. So it follows it up. And then when the stock turns, it would sell it at what your trailing stop was. So it's a pretty good stop to use if you're not going to be watching your position. One way to know where to put that trailing stop is to use an ATR, which is average true range. I don't use it. Let me put one up here real quick. Let's see, average true range. For instance, on this stock here, Caterpillar, if you wanted to put in a trailing stop, this right here is the average true range, which what this is it averages over the past 14 days. I think that's what this was, 14 day. Let's make that about a 10-day. So it takes these bars right here, are 5-minute bars. It takes the average over the last 10 days of the range from open to close on each of those bars. So right now the range of each of these bars is 14 cents. So depending on how much you want to risk, say you want to risk $200 on this trade, then you would take 14 cents, divide it into 200. You could buy, let's see, 200 divided by 14. You could buy 1,400 shares and put your stop in. I usually put it down a couple of cents lower, so it will give it a little bit of room to work. So you'd put your stop in about 16 cents lower than what you bought it at 1,400 shares, and then that you would be risking $200 on that trade. So if it did go down and stop you out, you'd only be risking $200. And again, that stop will follow the price up, and hopefully it'll go up a pretty good amount and then come back down and stop you out. So it's a little bit about trailing stops versus your fixed stop. Like I said, if you're going to watch it, um, I would just either put in a fixed stop or a mental stop. If you're not going to be watching your position, then I would probably use the trailing stop. And of course, you can always go to TraderTalkOnline.com. We do offer a live service there from open to close. You can see the trader's desktop. You can watch him trade and find where the action is. You can also chat with the trader and ask any questions you want. All of our traders have 10 years experience, and it's only $99 a month. So go to TraderTalkOnline.com. There's more information there, and I hope to talk to you soon.